All right, folks, welcome back to the Property Couch podcast. And have we got a great episode for you today? We are covering our Mythbusters series all around property buying. Stay tuned as we take you to the coalface of what's actually happening in the property market. What else, Ben?
Bryce, and in what's making property news, I'm at it again. Market intervention is absolutely destroying another international city's rental market. So I'm going to tell you all about it in what's making property news.
Not to be missed, folks. Check that one out. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast, and welcome back to you too, mate, after this first of back-to-back short weeks, Ben, over Easter. How was your weekend?
Yeah, no, good long weekend, mate. Always good to get away. Headed up north, up to the Murray River to see the folks at Yarrawonga.
Yes.
I had a great weekend. A bit of fishing, plenty of sitting around the open fire, and a sneaky little game of golf in there on Monday morning before I jumped back in the car and drove all the way back to Melbourne. So all good.
How'd you go with the golf? Did you just like riding a bike?
No, there's plenty of work to be done. Plenty of work to be done.
Well, I hope everyone who's listening to this, Ben, had a great long weekend, Ben. It's one of the great parts of the calendar, the early part of the year where there's those back-to-backs. And then you obviously get Anzac Day coming up too, which means another short week. So April is pretty much the 4-day work week.
And school halls. What about you, mate? Did you get away at all?
Went up to Kyneton and I had a great time up there with Andrea's family, and then I took the boys to the Hawthorn-Geelong game at the MCG. So first half was pretty boring, second half was pretty good if you're a Geelong supporter. And yes, again, purposely avoided talking about your team or my team.
Yes. No, let's move on, shall we?
Let's move on. Hey, great feedback from our guest last week, Kent Lardner, in terms of the insights that people get around what to look for in the data and how that's difficult. And so if you haven't listened to that, make sure you circle back. And today we're going to talk about Mythbusters, Ben. We continue our Mythbusters series regarding the buying process. So we're looking forward to that. But before we do, we just want to spread a message of caution because clearly we had an interest rate pause last week. And then all of the related headlines that come from that, Ben, because we've had, 10 months of headlines of doom and gloom. And then now all of a sudden people are saying, oh, are we through? Is this it? Are we done? And so we want to stay calm on that, right? Because although it was encouraging news, it's potentially not the end of the story.
Definitely not the end of the story. And I think one of the things that we are consistent on, and hopefully you'll also see through the flavour of this pod, is that that we're looking for rhythms that are medium to longer term. We're not necessarily interested in the short-term rhythms. Yes, we put a prognosis out there for the property outlook for 2023, but as you well know, we're interested in what's going to happen in 5, 10, 15, 20, 30, 40 years. And so part of what we're going to be talking about and building on what Kent was talking about last week was, what are those rhythms that are important for sustainable long-term investing, but also, getting you a bit of an insight in terms of what's actually happening out in the field.
Yes, very good. So my Mindset Minute theme today is setting us up for the conversation that we're having, Ben. But the quote is this: "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." And this has been attributed to many, Ben. Mark Twain. I think Mark Twain gets a lot of quotes attributed to him. Josh Billings, Will Rogers. When I had a look into the quote, there was no one had direct claim to it, but it's basically sometimes our preconceived notions or beliefs can be more detrimental than our lack of knowledge. So if we think something for sure and it turns out to be false or inaccurate, it can lead us astray and help us to make poor decisions. So I guess for us, it's about talking to a confirmation bias that we think may be existing in terms of what's actually happening at the coalface, at the street level, at the property level, because we're only hearing headlines. And today we're going to talk directly to that, and hopefully build some anecdotes and help people with beliefs that they may feel about it, because we're going to run through, we've asked our team to provide us with some feedback around deals and scenarios that they're facing at the coalface. And I want to highlight that we've been waiting to do this particular podcast for a couple of weeks, right? So the anecdotes that we're going to share today were actually pre the interest rate pause. They're actually back in the height of all of the anxiety that came from having 10 consecutive interest rate rises. So we're going to talk to that. We're going to talk to those anecdotes, and then we've got a couple of other myths that we're going to talk to at the end of the podcast as well. But hopefully this will be eye-opening for a bunch of people around what's actually happening at the coalface. So you ready for this, Ben?
Love it, mate. Let's rip into it.
All right, so we've got some anecdotes around the country, because we're not buying just in one particular region. So we're going to kick it off with Melbourne. And the first story is a property on the west of Melbourne. We're not going to get into addresses and those sorts of things for a couple of reasons. One, we don't want to give a fish. We want to teach how to fish, but also we don't necessarily want to create enormous traffic in the same places that we're buying, because we're doing that on behalf of our clients. But in the western region of the city, there was a property that was quoted at 9 to 950, and our buyer's agent couldn't make the first open, so the agent arranged to get it through on Tuesday morning, which is a benefit of having a buyer's agent. Now, what happened on the Saturday was 47 groups went through the open home. So we had a look through on the Tuesday. The Tuesday night, we get a phone call, and a cash offer had been received for 1.050. Okay, so if we go back to the quote of 9 to 950, they get a cash offer of 1050, and it was on the market. And by Wednesday at lunchtime, 12 o'clock, it was all done. So not even a chance to get a conversation with the client, because the market in that particular street on that particular property had moved so quickly. So, which is in direct contradiction to headline level, Ben.
Yeah, it is, and it's common. Even Bryce, and this sort of comes back to what happens in the field, right? It can be quite often that you get a great street, you get a great property in a great street, and it just bucks the trend in terms of even what's happening in that particular suburb. Now, in this particular case, we know the suburb well, we know what's going on there, and so this is an example of there is sustainable. When you got 47 groups through, what's that telling you? So around that $1 million mark, that might be traditionally in Melbourne, that's probably people's second home. They're getting on the property ladder. This is maybe their upgrader. From an owner-occupied point of view, and certainly from an investor point of view, this is a really nice sweet spot, that sort of $1 million for the Melbourne market. You're getting good land, you're getting good proximity to the city as part of that particular story, and the yields and the rental demand also stacks up for families in those locations. So it's just a really simple example of when the right asset appears in the right location, and it tests the level of demand.
I think that's an important point to raise here, because these properties are desirable properties, right? They're certainly A's and B plus properties. And what's happening is you're getting competition because of the fundamental principle that is recently seen grass shoots all across the country in terms of price movement north, is because we've got this gross undersupply. So if you've got this gross undersupply and something good comes up, those two things marrying together get you these conditions. Here's another one. There was a quote at 1 to 1.1. In the first week, they received an offer of 1.165. So that really starts to kick things off. So our buyer's agent had a phone auction on the Friday evening, missed the property, sold for 1.202 million, which was a pretty good price because it needed a little bit of TLC, right? But you've got a quote again at 1 to 1.1, sells for 1.202 million. Which again highlights what we're talking about if you get two or more people interested, right? So if you're sort of thinking, okay, 9 to 950, that one finishes at 1.2, sure, that's all right, that budget, hang in there, folks, because we've got a whole cross-section of prices, which includes in the lower price. So we're trying to give you a bit of a range here as well. The third one that we want to talk about in the Melbourne market, Ben, is a property that sold at auction for, wait for it, 1.095 million above reserve. Let that land. So it was a bit of a perfect storm. You had two neighbours and several sort of external owner occupiers were bidding, and it needed a complete renovation from the stumps up. It set a suburb record of 3.395. I can't do my stats today, Ben. 3.395 million, which was 95 above the previous record. It made the news. We weren't involved in the buying on that one, but it was just an interesting story to show again at the coalface. There's other things that are happening despite what you're hearing at headline level.
This is a good story of the inner city markets, which traditionally lead the way. So we're talking less than 5 kilometres from the city. Again, a really wonderful part of this particular suburb, always in high demand of new ones coming in. It really does highlight also the power of the emotional buyer, the owner-occupier buyer who sees a vision. Two neighbours. I'm not sure whether they're going to turn it into a tennis court or whether they're going to extend their existing home onto this new site. And then obviously a couple of people trying to get into this particular street in this particular suburb. Walkability score is really, really unbelievable in this particular location. So amenities everywhere. You can have a great lifestyle in this particular area. And it just, even though the property itself, from re-stumping, which gives you an idea that it's a weatherboard, and you're rolling out a sale price of $3,395,000 to set a new record for that particular suburb.
Yeah, so interesting for us to see at that level. But we've got more, right? So one of our buyers agents, Krista, sends you and me a text, right? We get some live updates, which is happening in the market. First one, this was. I looked at the text date. It was back on the 18th of March. So again, well and truly away from the shadows of an interest rate pause. And her comment was the market's back. There was a result at 1.52 with 6 bidders. In this particular case, we missed it. And I think, I think there's a lot of learning in us telling about the properties that we actually miss, Ben, because no one wants to sit here and go, we bought this one and we bought this one and we bought this one, because we're professional buyers and we're really proud of that. But I think some of the learning is in the mist, right? And the fact that buyers agents do actually miss properties as well. But we had a go, thought it was going to be at 1.512, ended up going for 1.52. So then drive in the car, go to have another look at a property not too far away. And the text was another missed one. This one sold 1.22750, which was 147,750 above the reserve, right? 6 bidders in total. So plenty of buyers participating over the last 3 weeks was the comment that Krista made. Now she's seeing them. She took the videos. If you could see from the text messages, we're seeing the videos and the walkthroughs and the traffic and the amount of people that are actually there. So what does this actually mean for confidence for the sellers? Again, this is prior to a rate pause. And then the last one was an agent within the same text flow that said that one sold for 1.973 and the reserve was 1.81. So again, in the higher echelons, but that's what you're getting in that inner market in Melbourne. But just to go to show that there's been plenty of activity for people buying for the right properties in the right conditions in the right streets, all harking back to what we've been saying before around when something good comes on, people come out and compete for it because there hasn't been a lot of good stuff on the market of late.
And look, the story of the 6 bidders on 2 of those auctions that we missed is an indication crowd numbers were strong. We do love it when we get this live feedback sort of Saturday afternoon. We start seeing the text messages come in from our buyers agents telling us a bit story of what's happening out in the field. We don't actively spend our weekends in the field anymore. We did it for a good decade or so there in terms of what we were doing. So, but one of the quick takeaways that I want to let the community understand is when you have consecutive interest rates of 10 times over, but you feel like the momentum's starting to taper out, and there's discussions about when is the pause, and the pause is coming. That's a conditioning signal that also happens. And what we've got to remember is Melbourne's a very, very, very wealthy city. And there's a lot of people with a lot of money in this particular marketplace. And so you don't need a huge depth in the market. You only need several emotional bidders coming into a marketplace that want in. And you start to see this price movement as part of these auction stories that play out. So I just find that, there's a lot of information out there. And when we're uncertain, like we were at the start of COVID, like we were with these interest rate increases in terms of where it was going, once we get more certainty and we get more comfort, we start to open up our wallets again when it comes to the property market. And I think we're seeing that in this particular story of Melbourne. And we know that this also been validated with our feedback from our buyers agency friends that we've got in Sydney as well, in terms of what's happening in that particular market.
Yeah, and it kind of reinforces a point that we did double click on last week or two around why we prefer these. You can tell from the price point, they're inner established suburbs, right? And it's because not all of the buyers within these markets are at the mercy of interest rates, because some have no debt, some have some debt, some have a lot of debt. And that's actually something that we love about the profile of the suburb. And I guess we'll talk to this a bit later on in the podcast too, but what will happen now is some of the spruikers will start to use the market conditions now, those little grass shoots, as reasons for why you should be getting back in. They'll have all sorts of marketing sizzle around why you should be getting in and buying their product, but they will be pushing you into locations that have a very concentrated price segment, and they will have a very high concentration of the demographic all at the same stage of the property cycle. High debt, very little will have no debt in there. Very little will have some debt. A lot of them will have a lot of debt, and so that's a warning signal for people to see that it's coming. You will see these people coming. They will come pretty hard, and they will use this period of time as a leverage point for you to get in for the wrong reasons and chase the wrong types of property. So I really just want to lean in on the fact that these suburbs are getting great results, because some of those results we'll never know behind closed doors, Ben, but some of them might have been paying cash for those results. They might have had a zero bit of debt for it, or they might have had a mortgage that was 300 and cash of 1.6 to buy that one that was around 1.8 million. So we won't know, but what we can tell is through the fact that there is history in the suburb, and the fact that we do know that people have we've got a $9.9 trillion asset and about a $2.3 trillion mortgage book across that asset. We know that just anecdotally that the more established the suburb, the longer it's been around, the higher the demographic of the people in, the more likely you're going to have a cross-section of people in different levels of mortgage that'll help underpin the suburb. So again, it's a point that we need to reinforce here.
Very much so, mate.
All right, let's move on to Adelaide. Okay, so that's Melbourne. So this particular market, we've got a couple of examples here, right? One was quoted at $399 to $438. 60 groups to the open, 20 offers. We put in an offer at $445. The land size was 720 square meters, but the agent wasn't very clear on exactly how much, but the agent said it was close to $500,000, which was, to be honest, for that location, was to quote our buyer's agent, was madness.
2024 prices.
Sorry,
2024 prices.
Yeah, but it needed painting, needed new flooring, needed window furnishings, it needed replastering in the kitchen. So there was a bit that needed to be done on it. But so we've just gone from the high price segment, Ben, and now we've dropped down to the more affordable price segment. 60 groups, 20 offers. We thought it was $445 and it went for $500,000. So, all right, there's some more evidence at that price point. What about another one? It was an auction. 5 building and pest inspections were done. So that's a good sign of how interested groups are looking to buy. 120 groups through the first opens, 10 registered bidders, and that one ended up buying under auction conditions for $657. So let's highlight what we got here: 120 groups, 10 registered bidders, 5 building and pest inspections at that sort of mid-price range as well. So there's 2 examples in Adelaide of something around $500,000 and something around that 650 level that are all experiencing similar conditions for competition.
Yeah, now, and proof is in the eye of the beholder, right? So when you're out there and you're in the field and you're seeing people lining up to get through the door and you're getting your name taken and, what's your phone number and blah, blah, blah. But the house is packed as you're walking through it and all that type of thing. That can give you that confirmation bias around that this is, I've got to get in this. Is that FOMO piece that sort of forms part of that particular puzzle. And that's true. That's where there's evidence that demand is superior to supply. So what you're also trying to understand is, where is this demand coming from? Is it just purely one side of the market? Obviously, is it just investor demand? Or are we seeing home buyers coming into the particular location? Because I'm interested as an investor in a strong home buyer interest and a strong idea of doing up and improving the neighbourhood and what's happening over the next decade or so, because that will then underpin those valuations in those particular areas. If it's just all investors coming in because they're sniffing a quick opportunity and they're thinking they can get this short-term growth in there, well, that's irrational exuberance, and ultimately plenty of them will be swimming naked when the tide goes out. So we got that confirmation in terms of the analysis we did on that area. We're very clear in terms of who our competition was in that particular case, and we can see that the vast majority of that was in the owner-occupier side. That gives us confidence that this is an area that families will, or people will move into. They'll create memories and they'll continue to keep investing into those particular areas. Beautification of the suburb, investment into the suburb and the streets in that suburb, and that bodes well for long-term underlying land growth in that particular area.
These are just reinforcing principles that we've talked about for a little while,
Correct.
haven't they, Ben? Like in terms of suburb and property type and demographic and the split across but again, in talking about some of these missed deals, I think there's real learning in the missed deals. So if we sort of go to Brisbane now, in general, anything that's beautifully renovated is getting a lot of attention, and that makes sense as a marketplace in general when you're on the back of building companies busting. Lead times, materials expensive, tradies charging a premium until all the work runs out. So it kind of makes sense that people are just wanting stuff that's done. They don't want that. They want the certainty of done versus the uncertainty of undone. But here's a couple of examples of, again, the learning is reinforced in the missed deals. So we talk to a missed deal here in the south side of Brizzy, passed in at auction in early Feb. The reserve was low 600s. There were 7 registered bidders. However, they wanted to purchase subject to finance, which is an oxymoron for auction, so it passed in. But we didn't participate in the auction as the client was waiting for equity release to be done so that they could participate. But the following Tuesday offered 625, subject to finance, building and pest, both 7 days. It sold for 650, unconditional offer. So again, missed out, and you see there's multiple interest there. Another one, another immaculately presented property, 8 offers received after the first open.
Bryce, what's interesting about this one, and this again shows you about the mindset and the conditioning of the buyers here. 7 registered bidders, but no one really wanted to bid at the auction. Now, remember, Brisbane, not an auction city, learning to become an auction city, but ultimately everyone keeping their hands in their pocket, thinking, well, I'm in a position of power here. But then ultimately that's early February. That's not happening now. And it changes on a dime. This is the point that you and I were making, in terms of when the market does move, it moves very quickly because the successful buyer, there's still 3 or 4 buyers that either have to buy or go and rent in a marketplace that's very expensive. So that then conditions them pretty quickly to then move to unconditional offers. And that's what we saw in that first example.
And what the team are saying, Ben, is they're seeing the same people rolling to the different
Yeah.
opens, and they see the underbidders, and they obviously see those underbidders will be at the next one, and then so if you're actually on the west side of the bottom, Ben, talking in graph moves, you're on the west side of the bottom, you're seeing that. On the east side of the bottom, when everything's starting to run a bit quicker, you're building momentum of not only
Yeah.
will you see the same buyers, but you'll see new ones every week. So that's important too. So that's the first one on the south side. The second one was an immaculately presented property. 8 offers, not one, not two, not four, Ben. 8 offers were received after the first home open on the first weekend. We offered 577 and a half, and thought that was good with the comps and everything in that range, but sold for close to 600. So there's another couple of stories from missed properties that you can actually learn from as well. We could tell you some stories about stuff that we bought as well. But again, just reinforcing, I think there's some learning here as well. So Melbourne at the higher price points. We've just gone to Adelaide at the sort of more affordable price points. Brisbane, they're at arguably the affordable to the higher price points again. And then Perth. Here's the quote from the team around Perth. Overall, just nuts. So, and we're seeing this too in the affordable price point too, because we had Damien Collins on earlier in the year too, Ben. You've got a median price in that city that's second in the country, and yet the in terms of their incomes, but the median price is lagging behind significantly. So money is moving there. So here's some examples that we can talk to. All right, on the south side, one sold for 621,000 to a local family. We offered 615, which we thought was a really strong offer, but in fact we came third. So it came online on the Tuesday. The first open was on the Wednesday. The second open was on the Thursday. Sold Thursday evening. So count it, Ben. Tuesday, Wednesday, Thursday, 3 days. The weekend home open was cancelled. So, and how many offers were on this property? 11 received in total, with the highest offer being the lowest offer being in the high fives. So there was a lot of competition. So that's one there. Here's another one. Sold after the first weekend open home with 9 offers received in total. Offered 447. Agent said the successful offer was $30,000 above this. Okay, so that's 2. Same story. Here's a third one. Went online on Wednesday at 10 o'clock. So the agent, because we'd previously missed one, so the agent said you should check this one out. We tried to organise to see it Thursday or Friday, but it was tenanted, so that made it difficult. So just had to wait for the home open on the weekend. So 9 offers came through on the Thursday night, and it was sold on the Friday morning, and no one even inspected it. Wow. So that's to give you a bit of coalface stuff over in Perth.
Is that rational behaviour? No. So this is what we are seeing in some of these Western Australian markets, is that there is a lot of activity from investors outside of WA. Now, what we've also got to remember in these particular markets, these prices are still at the levels that they were selling at in 2013, 2014. So I think that's probably giving a lot of those investor clients, especially with the yields and the vacancy rates over in WA at this entry-level price point. But there's no doubt that there is a wave of what we would call East Coast investors coming into this particular market. And when they're acting irrationally as they are, without sort of doing their full due diligence. Now, this one, they might be okay. This might be their 5th or 6th purchase that they're making, and this is how they play the game, and they're very skilled at what they're doing. But even that offer of that 30,000 above the 447, my rough math says that that's still above 5%, or it adds 3 to 5% or more to the price of the property from the underbidder. So that's just moved that market considerably there. And that is, again, potentially what happens in these markets where it has been quite dormant for a long period of time. It's now very clear that demand exceeds supply in this particular area. And a lot of these investors who have been waiting to get out to break even are getting out, and the new investors are coming in and basically going to take it for a run. So you feel for those older investors who are probably getting out a bit too early. but you've also got evidence again of a local family buying, with finance and a cash buyer for that first one that you talked about there. So, and these are established areas. These are homes that are around sort of 30, maybe even 40 years old these days in these particular locations. So, just says to you that the land scarcity isn't there. Sorry, is there, which means that we're not talking about new estate areas. So I think Perth is going to have a pretty good performance, I suspect, over the course of the next 12 to 18 months.
Agreed. So again, there you've got some examples of a cross section across the country, folks. So what is the myth that we were speaking to with these anecdotes? Well, the myth is that property market is dropping everywhere, and we can tell you at numerous examples that is not the case. Now, we can tell you also numerous examples where we picked up properties for clients as well. So that is a body of work that suggests that if you were to get down to quote, I guess, Kent last week, if all the headlines are at SA3, we're actually at SA1 here. We're getting very, very specific about certain prices within streets, within houses, and that's exactly the approach that we want to encourage you to do. And if we did a thesis at the beginning of the year that said that we think that there's opportunity if you get in, if you've got your buffers in place, all the basic mantras that we've talked to for a long time. We also talked about 3.6% being where we thought it might tip out. Now, we will be honest, Ben, there was some times where we thought that might not be the case, based on some of the movements that the RBA had done, particularly with their February move, which was soon after we talked to our thesis. But I guess what we're saying here is, if you are looking at the through the right lens, through the microscope rather than the telescope, there is lots of anecdotes and there is lots of evidence to suggest that prices are moving, properties are moving that are the right ones, based on the fact that I think is the biggest hindrance to the property market right now is the lack of stock. And it's not only flowing into buying, but it's also flowing into the rental as well, because the people who aren't buying are looking for rentals. And Ben, I think that should help with that myth that property prices are dropping everywhere, because we're seeing that it's not.
Yeah, and I think to build on your point, we've now got a sort of a prediction that it's more likely, from a 60% probability point of view, that property prices will stabilise and continue to grow, but not grow significantly strongly in all markets, and a 40% downside risk in terms of if inflation remains stubbornly high and there are potentially one or two more rate rises coming, because spending continues to keep going because everyone thinks we're out the other side of interest rate changes. That will then mean that obviously the property prices could still fall from here. But the reason why we're more confident of price growth from this point forward is the supply-demand story that we were talking about before. But we do know there's a lot of pent-up supply that also hasn't hit the market, and we will not know the answer to that for probably another 2 or 3 weeks, because that's the sort of build-up time that it takes for them to engage with an agent, do their inspections around, and then they're prepped to get their property ready for sale. So there's a 6 to 8 week program in that whole thing. So we're looking very intently in terms of what's happening on the supply side, because we know at the moment demand is there. And so, that's why we're quietly confident, but we're not screaming from the hilltop, but that's it. We're done. We're going to have rising tides lifting all ships again. We will see with interest rate falls, which may occur in 2024, that'll probably kick along the property market in some respects, and any changes to APRA's 3% buffer rates, which is really what it all boils down to in terms of borrowing power, will accelerate that further. So we're not all in on strong growth at this point in time, but we're sort of more optimistic than pessimistic in terms of how that looks.
Yeah, it's not like that post-COVID growth point where everyone was sort of raring at the gates to go. Interest rates were low. The times are different now, but I think the sense that it's probably speaking to the people that are keen to do something, like they're action takers, but they are uncertain and nervous. It's probably speaking to that group of people
Yeah.
more than anything,
Yeah.
because we're not property prosperity preachers all the time, right? But it's the people that are looking for signs to go, oh, it just doesn't like, I know that I've got a borrowing capacity. I know that I've got a buffer in place, but I just feel some deep sense of uncertainty as to being able to pull the trigger. We're probably speaking to that group of people that anecdotally at the coalface, there's not a lot to support the suggestion that the uncertainty and the anxiety that you're feeling has anything based on other than headlines, journalists who have an agenda to get our eyeballs, anything like that. Because I think everyone should take to heart the SA1 to SA3 and 4, because of the fact that you have to report at such a high level. I think that's really important.
Yeah, and I think it also highlights, Bryce, that there's still potentially a 10 to 15% chance of a greater than 5% fall continuing in the property market. But that actually means that there's a 85 to 90% chance that that's not going to happen, and we're going to see more growth than we are in terms of correction. So that's the way you should look at it. You should be looking at it as glass definitely half full. And we were talking in our update and our thesis around when can you predict the bottom? Very difficult to predict the bottom. And in a lot of cases, this is what we're arguing. We're arguing that there's a sort of 85 to 90% chance that we're past the bottom, and you didn't pick it if you haven't acted. But there's still, that those people that might be still a small group of people that are holding on the off chance that things are going to get worse before they get better. And there's a very, very slight possibility of that happening. And we don't want to underplay that. But, in terms of where all the data's putting it and where the human behavior and human activity is playing out, we're not seeing that coming up in terms of the results from a week-to-week basis in terms of price growth.
Well, it's a decades game we're playing anyway, so it's kind of just encouraging people to take action. Hey, this leads to the second myth that we want to talk to today. I'm going to just touch on it briefly too, Ben, because we have talked on it in the lead up to this conversation, but it really does sort of highlight the conversation that we've just been having, and it's around the time to transact. A lot of people say, okay, well, we've got this confirmation, we've got this external confirmation now that interest rates have paused. So therefore, I'm going to get in. And I'm going to say to you again and reinforce the time it takes to get ready. Because if you have a look at some of those other anecdotes that we talked about earlier around, okay, got listed on the Tuesday, bought on the Thursday, that takes a bit of time to get to be able to be that person that can buy in 2 days. Because you've got to make sure house is in order, ducks lined up in a row, all that sort of stuff, right? But then you've got to get out in the marketplace and get a feel for it. It's not like you go, okay, as soon as interest rates went on pause last week, everyone went out on opens on the weekend. Oops, no, everyone didn't, because it was long weekend. Everyone was doing Easter. So I'll get out this weekend and I'll have a look. And it takes a while for you to get a bit of a feel for what it is. And then you're trying to navigate price guides with agents and conversations that they're having. And you actually haven't been to opens for the last 8 weeks, for example. And so you haven't seen, when you go to the open, you can't identify, oh, that person has been looking for a few weeks, and oh, there's another person that missed, it was an underbidder last week. That stuff builds time. And I just want to smash the myth that now you've decided to buy, you can buy. The lead time is still very, very long for you if you are starting flat-footed at this point in time. And that's more than just getting ducks in a row, Ben.
Yeah, and you've made mention of that really since the start of this year's season of market updates, Bryce. Around it does take time, so I'm glad you double clicking on that particular myth again. Let's move to now the third myth, which is really around bargain property. Now we've talked about this before on the pod many a time, but the old bargain properties usually were the medium and high density stock that was sort of being offloaded, or the person before me paid X for it and I'm only paying Y some 6 or 7 years later, and so that just should give me confidence that I've timed it well and now I'm going to have a growth story. That is not necessarily how you get a bargain property. We've always talked about that it's a bargain property for a reason, and the fundamentals have still got to stack up in the short term, which is around that supply and demand story. But even in the medium to longer term, the livability, the human interest, human behaviour stuff, and there's always going to be risks in those particular spaces. So we talk about this quite often, but for the new people to the pod, it's really important for you to understand that where there's always added risk of additional supply being added and the risk of oversupply in particular areas, those types of properties will never be bargain properties, even though you feel like it's been a liquidated sale to you or whatever. You're not going to necessarily shoot the lights out when it comes to long-term sustainable outperform growth.
People have said to us, Ben, in this environment, we're looking for the bargain, and that's why it's come up again at this point in time, because we have spoken to this. You just need to go to the bargain rack in the shopping mall, and you see it and you get excited because you see the jumper or the jeans or whatever it is that you love, and you think, oh, wow, this is heavily discounted. I can't wait to take advantage of that bargain. And it's only then you realise that the sizes are in the outliers, right? And those sizes in the outliers mean that if they were in the bell curve, they wouldn't be on the bargain rack because they would have moved pretty quickly. And I feel like that anecdote speaks beautifully to what happens here. You can't get bargains in the real estate market for anything that you would want to have if you're playing the game that we're playing, which is the buy and hold for the long-term game, because the good properties are never at a bargain. So that one's come up again. It's a timeless one, but it's largely around the fact because we're talking to the sentiment of the market now, where people are saying, well, vendors will probably want to sell because the market is tanking. Well, hopefully the anecdotes that we've just shared to you will break that mindset around the fact that if it's a bargain, it is a bargain for a reason. The next myth I want to talk to is the perfect property myth. Which is just an excuse for procrastinating, in my view. I've seen it many times doing it on the show, Ben. I've seen it many times when I've been acting for clients. It is a alibi for procrastination because all properties have risk and uncertainty, and generally speaking, unless you have unlimited budget, you generally cannot satisfy 10 out of 10. You normally can get an 8 out of 10 or a 9 out of 10. So the myth of the perfect property is just call it for what it is. I'm nervous, therefore I will use it as a smokescreen for why I do not want to proceed in the look for this unicorn that generally for the majority of people who are buying properties doesn't exist.
Yeah, and I'll build on that. I've talked about top 40 music, right? The reason why it's popular is because there's a lot of other people who like it as well. So when you do get that perfect property, make no mistake, it's going to be under competition. And it then comes down to the deepest pockets and the most emotional buyer that's going to turn up on the day. So you might wait 6 months for that perfect property to turn up. Finally, this is it. Ticks all the boxes, Bryce. And I'm getting really excited. And there's another 60 people that have turned up for the open home, and there's 12 registered bidders, and oh God. And then so the expectation starts high, but the reality kicks in, and then you're, okay, well, I'm going to wait for the next one. Okay, that's good. So then you're paying $100,000 extra for waiting another 9 to 12 months for that.
Or in the case of the early anecdote, 1.095 above reserve.
Exactly. So, I think from, definitely if you're owner-occupier, I can understand how you might dream about what you're dreaming to execute on. From an investor's point of view, you've really got to be looking into, say, it ticks, 8 out of the 10 boxes that we're after, so it's a go zone, right? And usually from an investor's point of view, you're buying the 7.95s right through to the 9.2s. You're in that sort of spot where and you'll have a discussion around, well, the 7.95s need a little bit of work, but that can add some value. And then the 8s and the 9s, in terms of how they play out, it's like, well, we're just going to, go as hard as we can at a reasonable comp. But, at some point, as to the examples that we've used today, where we've missed out, where we've said enough is enough, that's because we've got a buying brief. And that buying brief has got to deliver a certain yield and a certain capital growth expected return. And so in some cases, they just don't make sense from a risk-adjusted return. So we tap out and we move on to the next opportunity.
Which leads into the next myth is the low maintenance property. if you're getting some of the old gems that we buy have a fair bit of maintenance. Some of the more recent properties have lower maintenance, but I guess there is a myth that that there sometimes want it to be a set and forget strategy forever, and I want to call this out too, Ben, because low maintenance still means that they are going to require ongoing maintenance, and at some point in the future, you're buying a depreciable asset. You're not buying a share certificate, Ben. You're not buying a unit in a fund. You are buying an asset that is depreciable, that is subject to weather, that is subject to wear and tear, that is subject to ongoing use by humans who, some people leave a very small footprint on their property, and some people leave a very high wear and tear footprint on the property, and that's hard to predict. So investing is inherently risky. You can mitigate the risks by asset selection, the defense you put in place, the landlord's protection insurance. There's a whole range of things that you can do to mitigate it. But the fact that it is set and forget, that is a strategy that is playing into the belief that we are playing a decades game. So you buy it, you set it up, and then you just get on with life and forget about it as an ongoing active management. It doesn't mean buy it, set it up, and never revisit it ever again, because that is just a mythological thought process. But Ben, it's sometimes as hard as it is to say. Sometimes we have dealt with people where they think, well, hang on a second, this wasn't meant to happen. Well, it's an asset that depreciates over time.
But it's the same argument for shares, Bryce. I mean, at the end of the day, I'm running a business. So let's go an example of a mining company. A couple of the buckets got damaged, or wear and tear, and I've got to replace the trucks that have done over 200,000 hours of work. So there's maintenance and ongoing costs of those. If I'm talking about supermarkets or retail, I've got to refresh my stores. I've got to, move to the different buying trends. That costs investment. If I'm a biotech company, I'm looking at the latest research labs, and I've got to invest in that research and R&D. So any investing has an investment into that. And I know in our book, we talk about reliable and durable properties, and we talk about, they need to have, you need to think about wear and tear, and, laminates and tiles and carpet, all of those things you need to think about wear and tear, because at some point they will all need to be replaced. And so the longer life you can get out of things. But you're right, we can buy an asset, and then in 6 months' time, we can discover that it needs some investment into it. Now, that investment that you're about to outlay could give it another 20 years, and you won't have to invest again. I mean, I've done fences, I've done patios, I've done rooftop terraces for water leaks, I've done fencing, glass fencing around pool area. All of those are part and parcel of the journey that you go on, and when it comes to not only repairs but also ongoing maintenance as well.
That's why investing is a process, not an event. The process means setting up buffers and thinking about having a plan that actually factors in maintenance as well.
Yeah.
So that you're looking around the corner. So there we go. So we've covered a few myths here. That the property market is going down. We've covered the short transact time. We've covered the bargain property. We've covered the perfect property. We've covered the low maintenance forever myth, Ben. So the last myth we want to cover here is the growth corridor myth. What does that actually mean, Ben? What does it mean when someone says you're buying in the growth corridor? Well, it means you've got to ask the next question. What sort of growth is the corridor measuring? Which is probably the best question you could ask, because quite often it's a population growth corridor, not a capital growth potential corridor. And that's an important one, Ben.
Yeah, it's important for a lot of reasons. And I think what you'll find is, with people who are really actively pushing property investment down your throats, what they try and do is they'll always have an angle. Now, I can see the new angle that they're going to attempt in the house and land and the off the plan stuff. And that is that there's a chronic undersupply. That means that if you put a deposit down now, even if it takes 2 years to be built, you're going to get all of that capital growth, and you're going to be able to hold on to that. So they'll have a rebuttal or they'll handle those objections that you might have around why this is a smart investment whilst it's not. We've always said to you that in terms of you're investing in the developer's profits. So we want the market to be tested in a resale environment. We don't want to be exposed to a collapsed builder, a collapsed new town square estate that's gone into liquidation, and all of a sudden, stage 3 land is sold for less, because they didn't, they've scaled back that centre village that they were planning in their master plan, and all of a sudden it's going to have a couple of shops in it, and the parks and gardens are not going to have the facilities and features that were once sold in the shiny brochure. So it's those types of things that we're always talking about in terms of reduce the downside risk, and you do that by testing a market. And we love the areas that have 10, 15, 20 years of resale, from the original subdivision that's going on in that particular location. Because from our point of view, that's when we do know whether the suburb did deliver to its promise or didn't deliver to its promise in terms of that underlying investment that's gone in there. And then ultimately that will then be judged by its land value over the long term.
Speaks to the heartbeat of this podcast and the reason why we started it too, Ben, because it feels like there's a turning point where people can get stuck on this whole growth corridor challenge. You and I recently had a look at a thread in one of the chat forums around one of the leaders of someone who is very strong in getting people in these growth corridors. And the responses that were coming back were a little bit frightening, to be honest, because it was almost like this person was totally blind to the impacts that the statements that he was saying would have on the people that actually end up buying the product that he was suggesting. So it kind of that's why this one came up for me, because it sort of stirred up those earlier emotions that. Way back when, Ben, when we were trying to stop people. Podcasts are common now, but back then there was this frustration. How do we talk to these people? And chances are we'll get to them too late. But they will use this as a big part of their spiel. They'll also talk to the fact that when you have the land that they're subdividing up, prior was a farm or a paddock. So the capital growth is quite phenomenal from when it was a paddock to when it's subdivided, because just the sheer fact that the volume of transactions that are happening in that area that weren't happening before, which speaks to what we were talking about with Kent last week around median prices, need to be reflecting of price segments in the area as well. So, this one's frustrating. We won't get enough of this message across to enough people before they get stung, but growth corridor doesn't mean capital growth corridor.
Well, social media is lit up with property investment advisory businesses or businesses that are claiming, to do all this and to have the right things. And look, again, 70 to 80% of things of what they say rings true, but it's the execution and it's the asset selection that becomes the real most important element of that. So they have a lot of money because they earn huge commissions off what they're selling, and they put a lot of that money straight into social media marketing, follow you around all of the social sites like Facebook and Insta and everywhere else, in terms of trying to convince you to come along to their workshops, etc., etc. So just be mindful that it's out there. We're trying to protect people from those. You always, one of the best pods we've ever done is the 4 ways in which you pay that Bryce put together years ago. That's such an evergreen podcast. Check that out. We might even find the episode link and put that into the show description as well, because that one's a good one as well. But I think these myths are always timely to come back to every few years. So I'm pleased we've sort of spent some time in talking to these stories, Bryce.
What's the takeaways then, Ben? So it's pretty simple that we feel that all of our underlying principles of buying when you're ready still remain, right? So you've got to have cash flow, you've got to have borrowing capacity, you've got to have line of sight on what's going on in the future, but also if you have the ability to see what's happening at the coalface, you get a better chance of actually jumping in, because if transaction times are a bit longer than you think, bargain properties that you want actually don't exist. There is no perfect property. I am going to buy a property that has some maintenance issues. And if I do buy in a suburb that actually has the right mix of ownership over a longer period of time, and by that I mean mortgage ownership, no mortgage ownership, a little bit of a mortgage ownership, and a lot of mortgage ownership. If you use those as your guiding principles, and you do your research at the SA1 level, not the SA3 and SA4 level, though, that'll give you the guidance to help you get set. And I guess if you have a decade's perspective, not a month's or a year's perspective too, that'll obviously help you stay on plan, stay on track, get moving, and know that I guess our final message too is stay cautious. Let's not get caught up in any hysteria about where the market's going.
Avoid the
Because
hype.
if you're relying on the markets doing stuff in the next couple of months for you to be successful at this game, that's not the message that we're spreading here.
Yeah, just avoid the hype. Clear and simple. Come back to the basics. Do your research. Do the fundamentals well. Take a long-term view, and pull your head up every 10 or so years and say, actually, this wasn't a bad idea. This whole property investment thing works.
There you go, folks. Some myths. Hopefully that will help you. My life hack today is I said last week I'm reading this book called Stolen Focus: Why You Can't Pay Attention by Johann Hari. I finished it over the weekend, Ben, and it's a couple of concepts I want to raise here. Surveillance capitalism, which is a concept which denotes the widespread collection and commodification of personal data by these corporations. That was really eye-opening for me. It's an arms race for our attention. They want our focus and they want us to stay on the phone. And here, they actually want us to skim because that's what's degrading focus. So here's a quote out of the book, Ben, that I found fascinating. Is that all of these tech companies could actually write a bit of code. Let's just use Facebook. They could write a bit of code that says, press this button to declare where you are right now and look for anyone who wants to hook up and have a face-to-face meeting. So Ben, I could be in Yarrawonga on the weekend. I could hit the button. You could go, I'm in Yarrawonga too. And then we connect, send text message, hey Ben, let's go for a beer or watch the footy, or we do something face-to-face. That would be super simple for these companies to do, and yet they don't do it. And the reason is they actually need the phone in front of your face. Their business model is incentivized about that. Now, I'm not telling anything, any breakthrough revelation here. I don't think anyone, but just the extent of how they went about doing that was fascinating in this book. So here's some life hacks that I've got from reading that book, Ben, because I think that fighting for our focus back is pretty important. So number one, it suggests deleting all your apps, which I did, right? I deleted all my social media apps off my phone. And I get that people listening to this go, okay, that's a bit extreme. I had cold turkey when I did it too, Ben. I picked up my phone and oops, the app wasn't there. But instead of just saying, I'm going to delete the apps and never return to them, what I've done is I've got the apps on my tablet, right? So I've got the apps available to me. They're just not available in my pocket so that I can actually stop that focus. That's number one. Number two, turn off all of your notifications. No one will know that's new for me, but I'm just sort of summarizing. So number two is turn off all of the notifications. The only way you can get my attention is via a text message. Otherwise, you can't. The third suggestion was don't touch your phone for the first hour of the day. So I've now moved my phone away. It's tucked away. It gets charged. It's in a cupboard. I can't get access to it. And then the fourth one was to read 3 to 4 pages of a book to reflex the focus muscle on your phone. So when you do pick up your phone, retrain yourself to go into to Kindle or iBooks or whatever app you use. Just read 3 or 4 pages as the first thing that you do. So I started doing some of those things, Ben, and they've made a difference. Have I gone, no, I'm never going to engage with these apps ever again? No, I haven't done that. But I've actually gamed my environment in a way that allows me to do it. I'm about 2 weeks in from that, Ben, and I must admit it's made a big difference. So I haven't missed out on anything. I still have access to them. It's just made a difference to the distraction. So they're my life hacks today as a result of finally finishing that book, Ben.
Beautiful.
What's making property news?
A couple of stories that caught my eye over the Easter break. the two main ones were, one obviously is building on what we talked about here today, which was a story out of realestate.com.au in terms of the turning point in the data. They looked at the March quarter and they looked at the different pockets of the market in terms of where the price growth was coming from. And it's no revelation, people. It's something that we've been saying for a long time. And that is that the top 25% quartile, so that's that higher end value, usually suffers in terms of price correction in uncertain times, but they're usually the first to respond in terms of the growth story. So we mentioned that in the economic and RBA update in terms of CoreLogic, PropTrack, which is also the research arm of realestate.com.au. They've reconfirmed that. And so those markets are definitely moving first, and the ripple effect takes place in terms of that. So we're seeing that in Sydney, we're seeing that in Melbourne. We've given you a couple of anecdotes in terms of some of those inner city results that you heard earlier in the pod today as well. So that one is just reconfirming what we've taught you from day one, is that land value, that top end of the market, those knowledge centres, the high income zones, the livability zones, the zones that get you access to all of the lifestyle drivers of big cities and knowledge centres, continue to show where the land value will ultimately grow over the long term, and that will ripple out into those other marketplaces. So that's consistent. But the other one, Bryce, and this one is the most concerning story, that I've read in recent times, and it's a building story, and it's building on the same story where I put my picker hat on here, and that was a story that was coming out of the London property market in regards to the chronic situation that London finds itself in regards to long-term rental accommodation. So we're talking about private rentals in this particular market. And again, through the intervention in the market, we're seeing a chronic level of undersupply of properties. We're seeing tenants or investors abandon this particular property market through the legislative changes that have been made, as I stumble through that word, legislative changes that have occurred during that time. So some of the big things that they've done are consistent with some of the discussions that we're seeing happening here, and the unintended consequences have been frightening. So we're talking about 20% rental price surges year on year. So we're seeing, and that is set to continue. In fact, some of the listed companies in the UK are saying, we can't see a stop to this, because effectively now they're making it almost untenable for investors to buy private letting property in the UK. You're now starting to see this chronic shortage. So it's only going to get worse before it gets better. And landlords are being very picky about who they're choosing in terms of they take on. Now, I know, Bryce, you want to talk to this point as well, but because when I showed you the article, you're like, oh my God. But there's an important point here. And the first one is that they stopped private investors claiming interest as a deduction against their properties. So we're talking about numbers around 30% of people are getting out of this particular marketplace. And that's going to be chronic, and just like what they're sort of talking about here in Australia, well, the build to rent, the big boys in town will come and get their tax incentives and concessions. But we are talking about a marketplace over there where it just does not make sense from an investor, when you look at the risk-adjusted returns, to actually invest in residential property in that particular marketplace. So it is going to be chronic until they then work out, actually, you know what? The best way to solve this is to just open the marketplace up. And then if there's really great rental yields and there's really great confidence that the governments aren't going to screw us, they will start to reinvest back into that particular marketplace. And then you'll have a level of rental accommodation which is sustainable for basically a global city like London, because it really is a problem that I'm seeing. You can see here, supply has dropped 35%, in terms of some of those markets, and 2-bedroom flats have risen by 59% in the past year, supply has dropped. So the demand's up 59%. Supply of 2-bedroom apartments has dropped 35%. What is that telling you? That's telling you that this market intervention has had unintended consequences, and they are that rents are going to go through the roof in London.
Ben, I think it's actually really good to think about this in terms of the super wealthy always find ways to minimise tax and to increase their wealth, right? So I guess the misplaced myth that property investing is propping up fat cats in this country, this is a beautiful anecdote to show exactly what's happening in another market, because the super wealthy just go off and find the other spot. But it's the people like to speak to our base, the people who are trying to self-fund their own retirement, right? And wouldn't class themselves as being wealthy or super wealthy. They're the ones that just go, throw my hands up in the air, don't want to play the game anymore because you're actually messing with the market too much. Therefore, I'm out. And so this is directly speaking to what actually happens. I mean, the closing part of this article, and we'll put the link so that we pay due respect to the journalist and the article. If you're planning to come to London, if you're coming to London and plan to rent, come armed with plenty of money, plenty of patience, and a pet CV. A pet CV.
Well, let me finish on this final point, Bryce. The average percentage of salary to rent now paid in rent reaches almost 50%. Now, 2 years ago, that was at 43%. Now, we here in Australia, where people talk about rental stress as being 30% of your income is for rent to up to 40%. Well, London is now approaching 50%, and it's getting worse. It is not going to get any better. So what is that doing for all these people? It's kicking them out of London. They've got to move out, and they've got to get the tube, and they've got to live in the satellite cities where it's a little bit more affordable. So it's doing a total injustice. It's totally impacting the market dynamic and letting the free market do its magical thing. And that's that is the beauty of free market, right? Free market enterprise says supply will come if the juice is worth the squeeze. But we're not seeing it here, right, in terms of that. So this is where bureaucrats and politicians and lobbyist groups all put their snouts in the trough and try and understand what they're trying to do here. And they just make it worse. They just make it worse. So that's what we've got to look forward to in this country. If we keep hearing about, the Greens lobbying for rental freezes and, the market's just not set up correctly here, open the market up. Let the market forces do their thing. That's the magic of an open and free market. And that's the message that I've got here in what's making property news, Bryce.
Well said, Ben. Good opportunity for people to really understand what might be around the corner if we get that wrong here in this country. So there you go, folks. We covered off some myths today. Hopefully that's helped you get a bit of a sense of what's actually happening at the coalface and some of the common questions and issues that our buying team faces. Just a shout out to our team to say thanks for collecting some of those ones that they did miss, Ben, so that we could use it as a learning opportunity here for all of our community on the Property Couch. So, mate, it's been fun. We're going to cover some more myths in upcoming episodes. But until next week.
Knowledge is empowering, Bryce, but only if you act on it, because your future self will thank you for it.
There it is, folks. See you next week.